Warren Buffett reveals 12 financial mistakes investors make. Welcome to Money Ocean, your go-to channel for all things finance, wealth, and success. I'm excited to have you join us as we delve into the world of investment and uncover the financial mistakes investors should avoid. Today, we're diving deep into Warren Buffett's wisdom as he reveals 12 common pitfalls in the world of finance. Attempting to time the market. Buffett says it's a big mistake to focus too much on forecasting market moves. Rather, he suggests focusing on finding excellent companies at reasonable costs. It's similar to trying to forecast the weather, which is frequently erratic and inaccurate. Pay attention to each company's unique fundamentals instead of following market trends. Recall that prudent and patient investment is more important for success than trying to time the market. You may keep away from the dangers of market timing by focusing your attention on long-term value. Overestimation of growth. Many businesses set high growth targets for themselves, but Buffett cautions against placing too much trust in these projections. Rarely do businesses possess the long-term stability necessary to sustain such rapid growth rates. Although expansion is ideal, it's critical to assess a company's potential realistically. Before assuming the company will continue to grow at a rapid pace, take into account its competitive advantages and the dynamics of the industry. Keep in mind that gradual, steady growth is frequently more sustainable in the long term. Taking on too much debt. Buffett compares playing Russian roulette to having excessive leverage. Using borrowed funds to increase profits may seem alluring, but if things don't work out, it could result in severe losses. Making educated selections is more important when it comes to investing than taking needless risks. Keep in mind that debt amplifies benefits as well as losses, so utilize it carefully and sensibly. You may shield your investments from needless risks by sticking to a cautious leverage strategy. Being preoccupied with the purchase price. Individuals frequently focus too much on the price they paid for a stock. The stock doesn't care if you bought it high or low. Its future performance is what matters. Don't let your judgment be influenced by your feelings about purchase pricing. You should not assume that just because you paid a specific amount, it will function as expected. Rather, concentrate on the company's inherent worth and future growth prospects. Recall that future prospects, not previous purchase prices, determine the best investments. Limiting the types of investments you can make. Buffett cautions against overly narrowing your investment universe. Keep your options open, because you never know where an opportunity may present itself. Don't limit yourself to particular sectors or industries. Keep your options open when it comes to making investments. Extending your reach can make it more likely that you can discover profitable prospects in underutilized segments of the market. Recall that diversity across several industries can improve portfolio performance overall and reduce risk. Excessive activity. Contrary to popular belief, consistent action is not necessary for successful investing. Like waiting for a fat pitch in baseball, Buffett advises waiting for the appropriate opportunities. It's about making thoughtful judgments instead of making lots of trades. Quality over quantity. Recall that patience is a virtue when it comes to investing. And sometimes, doing nothing at all is the best course of action. You can reduce transaction costs and increase long-term gains by abstaining from pointless trading. Paying attention to small details. Buffett stresses the need for a broad perspective. Avoid becoming mired in minutiae such as labor contracts or lease agreements. Instead, concentrate on understanding the larger economic environment, the management standard, and the investment cost. Occasionally, Obsessing over trivial details can divert your attention from the crucial elements propelling a business prosperity. Recall that, in the end, what matters most is the state of the business as a whole. Verification bias. Investors frequently look for data to support their pre-existing opinions, which results in biased choices. Buffett cautions against this and urges investors to assess all material rigorously, especially if it contradicts their assumptions. Investors can avoid cognitive biases and make better informed decisions by keeping an open mind and taking into account different points of view. To help you make smarter investing decisions, never forget to examine your own assumptions and look for different viewpoints. Excessive diversification. Buffett thinks it's better to focus on a small number of outstanding companies rather than overcommitting to too many. While diversification is important, too much of it will lessen the impact of your best investing ideas. Prioritize quality over quantity. Remember that having too many stocks can make it difficult to monitor the performance of individual companies and may prevent you from taking advantage of your best investing opportunities. Concentrating on a small number of investments can increase the possibility of earning enormous profits. Trying to make things too complicated. Buffett values simplicity over intricate details. He thinks it's best to invest in companies that are simple to comprehend. Attempting to manage excessively complex companies or investment strategies frequently yields poor outcomes. Stay within your area of expertise and comprehension. Recall that simple companies with steady profits tend to offer the finest investing prospects. Maintaining a straightforward approach to investing can help you steer clear of pointless risks and concentrate on long-term gains. Adhering to the herd. It's not always a good idea to do something just because everyone else is doing it. Buffett cautions against following the herd mentality since it frequently results in bad investment choices. Think alone and independently of others. Recall that fear and greed are the driving forces behind the market, and going along with the crowd might result in purchasing at the top and selling at the bottom. You may avoid following the crowd and make more logical investing selections if you continue to have a contrarian approach. Lost chances. Buffett concludes by emphasizing the value of grasping opportunities as they present themselves. It can be expensive to put off taking action because you're unsure or attached to past rates. When you spot a good investing opportunity, follow your gut and take decisive action. These 12 blunders teach us important lessons about investing. We should be realistic, concentrate on the long term, and base our judgments on solid ideas rather than feelings or fads. Investors might improve their odds of making money in the stock market by avoiding these traps. And there you have it. We've navigated through Warren Buffett's insight on avoiding financial mistakes. I hope you found today's episode insightful. Don't forget to subscribe to Money Ocean for more valuable content on finance and wealth building. Until next time, smooth sailing and prosperous investing.